Welcome back to Miles Macro. I'm your host, and today we aren't just looking at charts. We are looking at history unfolding in real time. There are decades where nothing happens, and then there are weeks where decades happen. We have officially entered one of those weeks. If you've been following this channel, you know we spent the last 48 hours discussing the lockstep movement of oil, gold, and silver. We watched the source code of the markets, the informed money positioning itself for a tail risk event that most analysts were still calling low probability. Yesterday, we talked about hard assets spiking together as a warning shot. Today, the sirens are no longer metaphorical. The geopolitical tail risk has materialized into a full-scale kinetic conflict. This is the moment where macroeconomic theory meets the brutal reality of the front line. For months, we've tracked the widening gap between paper prices in the West and physical demand in the East. We've discussed the fragility of the global supply chain and the weaponization of the dollar. But as of the early hours this morning, the narrative has shifted from if to how long. The United States has officially declared the commencement of major combat operations against the Islamic Republic of Iran. When we talk about informed money, we're talking about those who didn't wait for the headlines. They read the market structure, they saw the silver lease rates spiking, they saw the physical premiums in Shanghai hitting record highs while the COMEX was asleep. They knew that when gold, silver, and oil move in a synchronized upward surge during a period of supposed negotiation, the negotiation is already over. The market leads, and the headlines follow. Today, the headlines have finally caught up to the price action, and for many investors, the realization is coming at a very high cost. While most of the Western world was asleep, the geopolitical landscape of the Middle East was permanently altered. This wasn't a limited tit-for-tat exchange or a symbolic strike on an empty desert outpost. This was a coordinated, high-intensity decapitation strike launched by U.S. and Israeli forces. The operations began with precision airstrikes on central Tehran. Reports confirm that the primary targets were not just military hardware, but the very seats of Iranian power. Missiles and stealth assets targeted areas in immediate proximity to the Iranian presidential offices and, most critically, the compound of Supreme Leader Ayatollah Ali Khamenei. In a televised address that will likely be studied for decades, Donald Trump stated explicitly that the United States has begun an operation to annihilate Iran's navy and obliterate its missile industry. This is a total mission objective. We are no longer talking about containment or sanctions. The goal, as stated by both U.S. and Israeli officials, is the total dismantlement of the current regime's ability to project power. Trump's rhetoric was somber but decisive, acknowledging the gravity of the situation by stating, "The lives of courageous American heroes may be lost, and we may have casualties. That often happens in war." The Iranian response was instantaneous and massive. This wasn't a measured retort, it was a desperate, multi-front barrage. Iran launched ballistic missiles targeting U.S. military installations across 5 separate countries simultaneously: Bahrain, Qatar, Abu Dhabi, UAE, Kuwait, and Saudi Arabia. Think about the macro implications of that for a moment. We are seeing kinetic strikes across the most sensitive energy corridor on the planet. The UAE, Qatar, and Kuwait have moved to immediately shut down their airspace. This isn't just a military problem. It is a total shutdown of the logistical hub of the Eastern Hemisphere. The rhetoric coming out of Tehran is equally absolute. Iran's foreign minister was forced to publicly confirm that both President Pezeshkian and Supreme Leader Khamenei survived the initial waves, but he followed that with a chilling caveat. There are no red lines anymore. Everything is possible now. This sentiment was echoed by the Yemen-based Houthis, who announced they are resuming full-scale attacks in the Red Sea, effectively pincer-closing the world's most vital shipping lanes. Several major oil conglomerates have already suspended all shipments through the Strait of Hormuz. We are watching the physical choke points of the global economy tighten in real time. What makes this escalation different from 2020, or even the regional tensions of 2023, is the clarity of the objective. Israel has stated its goal is to end the Ayatollah's regime entirely. Trump has called on the Iranian people to overthrow their government the moment the airstrikes conclude. We have moved past the era of strategic patience into an era of regime decapitation. A U.S. official has confirmed that these airstrikes are scheduled to continue for days, if not weeks. We are looking at a sustained campaign designed to strip Iran of its defensive capabilities and its command structure. For the markets, this means the uncertainty isn't going away by Monday morning. The busy weekend Trump alluded to is just the opening act of a much longer, much more volatile chapter in global history. In the world of Miles Macro, we look for the signal amidst the noise. The noise is the frantic scrolling through Twitter feeds and news alerts. The signal is the fact that physical gold is trading nearly $300 over paper prices in Asia, while US bases are under fire. The signal is the total collapse of the normalization narrative. As we move into the next sections, we're going to look at exactly how this kinetic warfare is translating into financial warfare and why the physical divorce between the East and the West has reached a point of no return. If the initial US-Israeli strikes were a surgical attempt at decapitation, the Iranian response was a shotgun blast across the most vital economic corridor in the world. This isn't just about a localized conflict anymore. We are watching a regional conflagration that has effectively paralyzed the global energy supply chain in under 24 hours. Iran did not just target Israel. In a move designed to punish any nation hosting American military assets, Tehran launched simultaneous ballistic missile volleys at U.S. bases in Bahrain, Qatar, the UAE, Abu Dhabi, Kuwait, and Saudi Arabia. Think about the sheer geography of that strike. These 5 nations represent the backbone of global oil production and logistics. By hitting these locations simultaneously, Iran has sent a clear message to the world. If our regime falls, the global economy falls with us. This wasn't a measured response intended to save face. It was a scorched earth policy initiated the moment the first bombs fell on Tehran. Immediately following the strikes, the UAE, Qatar, and Kuwait, 3 of the world's most critical transit hubs, completely shut down their airspace. For anyone tracking global logistics, this is a nightmare scenario. We aren't just talking about delayed vacations. We are talking about the total cessation of the Middle East bridge that connects European markets to Asian manufacturing. When you combine this with the Yemen Houthis announcing a resumption of attacks in the Red Sea, the pincer is complete. The Suez Canal and the Persian Gulf are now essentially no-go zones for Western insurance underwriters. The Iranian foreign minister's statement that there are no red lines anymore is the most significant macro signal of the day. In traditional diplomacy, red lines provide a framework for de-escalation. They tell the opponent where the limit is. By removing them, Iran is signaling that asymmetric warfare is now the primary tool. Cyber attacks on Western banking infrastructure, sabotage of underwater fiber optic cables, and the mining of the Strait of Hormuz are all now on the table. Already, major oil companies have suspended all shipments through the Strait of Hormuz. We are no longer speculating about supply disruptions. We are witnessing the physical removal of millions of barrels of oil from the daily global market. The informed money we discussed yesterday, the ones buying oil futures in the dark, weren't just hedging, they were front-running a total blockade. Now, let's talk about the money. Because while the headlines focus on the explosions, the real war is being fought in the price discovery of hard assets. We are currently witnessing what I call the Great Physical Divorce. This is the moment where the paper price of gold in London and New York becomes completely irrelevant to the actual cost of owning the metal. While the COMEX and the London Bullion Market Association, LBMA, were closed for the weekend, we had a leak in the system, PAXG. For those who don't know, PAXG is a crypto token backed by physical gold. Because it trades 24/7 on crypto rails, it serves as the world's only real-time war barometer when traditional markets are shut. Overnight, PAXG spiked to an astronomical $5,600 per ounce. Think about that. On Friday, the Western paper spot price closed around $5,278. Within hours of the strikes on Tehran, the informed money on digital rails was willing to pay a 6% premium just to get exposure to gold before the Monday morning gap. It came within $50 of its all-time high of $5,650. This isn't volatility. This is a panicked flight to safety. But the real story is in the East. In the dark market of China's spot gold, prices were quoted at 1,226 yuan per gram. Do the math. That converts to $5,560 per ounce. This creates a $282 premium for physical gold in Asia compared to the Western paper price. Let that sink in. If you are in London, the screen tells you gold is worth $5,278. If you are in Shanghai or Singapore and you actually want to hold the metal, you have to pay nearly $300 more. This premium, which experts said was a temporary anomaly months ago, hasn't just persisted, it has exploded. When markets break, they don't break slowly, they snap. Look at Thailand's Ha Sang Hung, one of the largest gold dealers in Southeast Asia. They have completely halted all gold trading. Why? Because the price volatility is so extreme that they can no longer manage the risk. When a major regional dealer refuses to sell their inventory at any price, you know the paper system has lost control of the physical reality. We are living in 2 different universes. In the Western universe, the average investor still only has a 1% to 2% allocation to gold. They are sitting on paper wealth, believing the system will remain orderly. In the Eastern universe, the world's largest gold market is pricing in a total systemic reset. War is the ultimate auditor of value. It reveals what is real and what is claim. During this weekend's escalation, the market has sent a clear message. Physical gold is the only safe haven that matters when the missiles start flying. The paper contracts, the IOUs traded on the COMEX are being exposed for what they are, digital promises that may or may not be fulfilled in a world where the Strait of Hormuz is closed and 5 nations are under fire. The divorce is here. The question for you is, which side of the price gap do you want to be on when the Western markets open in 30 hours? If gold is the heartbeat of the global monetary system, silver is the central nervous system of the industrial world. And right now, that system is flashing bright red. While the mainstream media is fixated on the explosions in Tehran, the data coming out of the silver warehouses is telling a story of a system nearing a total physical breaking point. Let's look at the numbers because numbers don't lie. In the last reporting cycle, COMEX registered silver. The silver actually available for delivery saw an influx of 2.3 million ounces. Normally, that would look like a build, but look at eligible silver. It fell by 2.6 million ounces. We are seeing a desperate reshuffling of deck chairs on the Titanic. Total COMEX silver sits at 360.3 million ounces, but the quality of that inventory is under suspicion. The most shocking metric, however, is the open interest. In just 1 month, open interest on silver futures collapsed from 162,000 contracts to 118,000. That is a 27% drop in paper positioning. Here is the kicker. Usually when open interest collapses, price follows it down. But in this case, the price of silver climbed from the low 80s to over 95. This is a massive divergence. It tells us that the paper shorts, the banks and speculators are being forced out of their positions while the physical longs are taking control. The paper market is shrinking because it can no longer contain the physical reality. For the macro nerds watching, pay attention to the lease rates. Silver lease rates have spiked for 6 consecutive days, hitting 1.6%. In a normal market, lease rates are negligible. When they spike, it means someone, likely a major industrial user or a bank, is so desperate for physical metal that they are willing to pay a premium just to borrow it for a few days. We're seeing the March contract outperform the May contract for 4 days straight. We're seeing silver swaps hit their most negative levels since mid-February. These aren't just technical indicators, they are the sounds of the plumbing breaking. This positioning was building before the war news dropped. The informed money saw the supply stress signals flashing red long before the first missile was fueled. Now, look at the price arbitrage. Western spot silver is trading around $93. Meanwhile, in Shanghai, spot silver is at $105, and futures are at $108. That is a $12 to $15 premium between the physical East and the paper West. One source reported that the largest recycling company in Shenzhen is offering nearly $15 over spot for 99.99 silver. They aren't doing that for fun. They are doing it because they have industrial orders that must be filled, and they cannot find the metal at Western screen prices. When industrial demand and investment demand collide in a market with a structural deficit, the paper system loses its ability to set the price. The short squeeze of the century isn't coming. It's already happening in the physical market. This brings us to one of the most controversial topics in macro today, the digital gold narrative. For years, we've been told that Bitcoin is the ultimate safe haven, a decentralized asset that would thrive in a period of geopolitical chaos. This weekend, we got the definitive answer to that thesis. The moment the strikes hit Tehran, the market went into audit mode. What happened? Bitcoin didn't spike to $100K. It didn't even hold its ground. Instead, Bitcoin plunged to $63,000. In a matter of 15 minutes, over $100 million in leveraged long positions were vaporized. While physical gold in Asia was hitting new all-time highs and trading at massive premiums, Bitcoin, the supposed digital gold, was being sold off to cover margin calls. This is the brutal reality of the crypto market. It is still, at its core, a risk-on asset driven by liquidity and leverage. When the world catches fire, traders don't run to Bitcoin. They run from leverage. This isn't an attack on Bitcoin's long-term potential, but it is a necessary correction of the safe haven myth. In a kinetic war scenario, safe haven means an asset with zero counterparty risk and zero dependency on the electrical or internet grid. When gold surged and Bitcoin fell, the market was showing you what a real safe haven looks like under pressure. Gold is a flight to safety. Bitcoin, in its current institutionalized form, is a flight from risk. If you are holding Bitcoin as a hedge against a world where 5 countries are being bombed and the Strait of Hormuz is closed, You are holding a liquidity proxy, not a monetary anchor. As Jack Schwager documented in The New Market Wizards, the most successful traders share one trait. They don't wait for confirmation. They act when probability shifts, even if it feels uncomfortable. The informed money didn't wait to see if Bitcoin would act like gold. They saw the lockstep movement of gold, silver, and oil on Friday, and they bought the physical assets. They knew that in a true systemic crisis, the market returns to its most primitive and proven stores of value. The $282 gold premium and the $15 silver premium are the market's way of saying, we don't want your digital promises, we want the metal. The divergence we saw this weekend is a watershed moment. It has exposed the fragility of the paper systems and the digital gold narrative simultaneously. As we head into the next 48 hours, the question isn't whether the price will go up, it's whether the paper markets will even be able to function in a world where physical reality has taken over. There is a famous line often attributed to Lenin: there are decades where nothing happens, and there are weeks where decades happen. As we watch the smoke rise over Tehran and the ballistic missile trails over the Persian Gulf, it is clear we have entered one of those weeks. But for the astute macro observer, this isn't just a black swan event. It is the sudden, violent acceleration of a structural collapse that has been decades in the making. In Michael Lewis's The Big Short, he documented how the housing market didn't collapse gradually. It was held together by duct tape and denial for years. Everyone knew the subprime loans were garbage. Everyone saw the rising defaults. But the paper system, the ratings agencies, and the big banks kept pretending the reality didn't matter until the day the whole thing unwound in a matter of weeks. The silver and gold markets have been running on that exact same playbook. We have seen 10 consecutive monthly green closes on silver. We have seen gold hit its 7th straight record high. We have seen persistent deficits, draining inventories, and widening premiums for months. The cracks were visible to anyone willing to look at the COMEX registered levels or the Shanghai premiums. But the Western paper markets kept pretending that physical reality was a secondary concern. Eventually, physical reality wins. And when it does, the adjustment is never orderly. What we are seeing this weekend with Thailand dealers halting trade and Asian recyclers paying massive premiums is the sound of the duct tape snapping. Precious metals currently sit at the ultimate fault line of the global economy. They are benefiting from 4 massive accelerators that have all activated simultaneously. Geopolitical chaos. War drives immediate safe haven demand. Monetary breakdown. Dollar weaponization drives sovereign nations to diversify into neutral assets. Supply disruptions. The closure of the Strait of Hormuz and the Red Sea drives industrial users to hoard whatever physical metal they can find. Structural deficit. Mine supply simply cannot keep pace with the massive shift toward hard assets. When $650 billion is added to the precious metals market cap in a single surge, that isn't just war jitters. That is a structural repositioning of the world's wealth. The informed money has decided that the risk of holding paper promises is now higher than the cost of paying a $300 premium for physical gold. As we sit here, Western markets are still 30 to 40 hours away from opening, but don't be fooled by the close sign on the New York Stock Exchange. Price discovery is happening in real time through the source code channels we've discussed. When the futures markets open on Sunday evening, they aren't going to drift higher, they are going to gap. Based on PAXG trading at $5,600 and the Shanghai dark market at $5,560, the fair value for gold is currently hundreds of dollars above Friday's close. The question every Miles Macro viewer needs to ask is, will the paper banks allow it? We have seen this movie before. Geopolitical events spike the price, and then, within hours of the Monday open, the big banks slam the paper markets with massive short orders to protect their positions and dampen the panic. But this time feels different. Why? Because of the duration. U.S. officials have already confirmed that strikes will continue for days, if not weeks. This isn't a one-and-done headline. With Iran striking 5 countries and Israel aiming for total regime change, the uncertainty isn't going to be resolved by a Monday morning press release. As we head into this busy weekend, here is your playbook. Verify the physical paper spread, watch the Shanghai premium. If it stays above $300 for gold and $12 for silver, the divorce is accelerating. Monitor the Strait of Hormuz. If oil companies continue to suspend shipments, the inflationary shock to the West will be immediate and brutal. Watch the COMEX vaults. On Monday and Tuesday, look for eligible to registered shifts. If dealers panic and start moving metal to cover deliveries, the squeeze is on. Ignore the digital gold noise. For now, Bitcoin is a liquidity proxy. Gold and silver are the monetary anchors. Distinguish between the two in your portfolio. This isn't financial advice. This is financial warfare education. War is the most volatile variable in macroeconomics. It can de-escalate as quickly as it began, and premiums can compress. Paper markets can and often do slam the physical price lower in the short term to create the illusion of stability. However, structural deficits don't disappear because a futures trader in Chicago presses the sell button. The physical buyers in Asia who are paying $105 for silver aren't doing it because they're hyped. They are doing it because they see a world where delivery certainty is the only thing that matters. Invest with logic. Read the market structure. Follow the money flows. The ones who waited for the official confirmation this morning woke up to war and prices that had already moved. The ones who watched the lockstep movement of oil, gold, and silver on Friday are the ones who are currently sitting on the gains. Stay sharp, stay hedged, and I will see you on the other side of the Monday gap. This is Miles Macro, signing off.